Coming up in today's show, stocks fall for the third straight day on the back of stronger than expected jobs data, and the market now pricing in a greater probability of another Fed hike, some bullish and bearish arguments, foreign central banks piling into gold, China seeks to go after Apple even more, the risks and opportunities of further China aggression, and will the new iPhone 15 save Apple? Hey, what's up guys? Welcome back to Click Capital, your favorite finance channel on YouTube. I'm your host Jared, and I'm going to run you through the most important news, data and charts from the markets today. Get you all up to speed on what's happening out there and where the potential risks and opportunities may lie. And so the market was led lower today by Apple, again down almost 3%. And so today we're going to dive a bit into Apple and China, and what could be the beginning of more outlashing by China towards American companies, and a further deepening of tensions and the conflict and economic Cold War that is already underway. In addition to Apple, we also saw the chips come off hard today, and then what has been a change of late is we saw a bit of a defensive rotation into sectors like healthcare, utilities, and consumer staples. Also upsetting the market today was an extension of the recent trend of good news is bad and bad news is good. And so we're still getting a little mixed data from the jobs market. The recent trend of late, we're seeing a bit of a softening. However, we just got the latest weekly jobless claims, and they came in at the lowest level since February. And so last week we had 229,000 people filing for jobless claims for the first time. This week we expected 234,000. That actually came in a lot lower at 216,000. And another sign that the jobs market is still holding up. And the process of the jobs market turning can take many months, sometimes a year or longer. However, for now it is holding up, and we can see that also in the unit labor costs, which are up 2.2% quarter over quarter, and productivity holding up there as well at 3.5%. And so the interest rate market is really sensitive to every new piece of economic data now. And for the first time in a little while, the market's now flipped back probabilities to 51% chance the Fed will do a hike in November. So it's pretty much a given that the Fed's going to pause in 2 weeks when they meet. And we can see here in the probabilities as derived from the Fed Fund futures market is 48.3% chance they'll do a 25 basis point hike, and even a little 3.4% chance that we'll have had 50 basis point hike by then, with that little bit of a chance that we do get a hike in 2 weeks. But I don't think they'll hike in 2 weeks. I think right now the Fed is exactly like the market. They're not sure whether they're going to hike again in November. It's all really dependent on the jobs and inflation data reports that we get between now and then. So the window is still open for another hike. However, we'll just have to keep watching the data and what the price action tells us as to whether that is a real possibility or not. However, regardless of the possibility of continued interest rate hikes, we've still got vocal bulls out there, with one of the most known probably being Fundstrat's Tom Lee. And on this channel, I always try to remain somewhat neutral and present both bullish and bearish arguments, then try to find where the weight of the evidence lies and talk about probabilities. And so some of the bullish reasons the market could still go up from here. He pointed out that falling used car prices should help push down inflation. And while September is historically the worst month of the year for the stock market, based on Lee's analysis, since 1950 there have been 8 months when stocks were up more than 10% through August, but down in the first 3 days of September. In 5 of those 8 months, stocks finished high for the rest of September. He also pointed to positioning that suggests investors may be nearing levels of capitulation based on the equity put-to-call ratio, which hit 1.2 on Wednesday. He said used car prices, which drives 15% of consumer inflation, will continue to fall lower, and is of the opinion that inflation is going to keep tracking down. Other bullish research analysis out there are saying in September, the AI theme could offer a boost to investor sentiment thanks to upcoming announcements from Microsoft, Meta, and Salesforce. With Microsoft and Meta both set to hold events in September to show off their latest innovations in artificial intelligence, and along with Salesforce with its annual Dreamforce conference. And this analyst is going as far to say as AI is probably not priced in, and we're still in the early innings. Another bullish argument out there is investors holding cash. And it's true, there is $5.5 trillion in money market funds, which has increased dramatically this year, especially after the failure of those regional banks back in March. However, let's not forget, all that cash is earning over 5% now, so those investors are probably happy, and there's a much bigger hurdle for the stock market to jump over to attract most of those funds back in. Another catalyst for the market could be the market's biggest stock, Apple, and them unveiling their latest generation of iPhone, the 15, on September 12. And it's true, if the market does get excited over that and Apple can break out to fresh highs, along with NVDA, that's going to pull the Nasdaq and most likely the rest of the market up with it. However, over to bearish arguments, it is hard to ignore the fact that rising interest rates are likely to have more companies defaulting. Like Howard Marks mentions here, he said when you go into a period when it's difficult to raise money, even for a good purpose, clearly many more companies are going to founder. He said that even when inflation falls to the 2% target, he isn't expecting a return to the easy money era. between 2009 and 21 when interest rates were near zero, and he puts it in a good way when he says you can't live on a shot of adrenaline every morning for 13 years. We got another billionaire investor echoing the same sentiment. Leon Cooperman sees a recession and doesn't expect a new high in stocks for a long time. He said, what's the sign that interest rates are too high? The stock market's been going up. The market has a very speculative tone to it. In Georgia, their flash estimate in GDP was like 5%. There's no indication that the Fed is restrictive. Without a hawkish Fed, the billionaire expects the US economy to suffer a hard landing, naming a number of factors that could push it over the edge. These include quantitative tightening campaign, the rising price of oil, or the US dollar. He said, I don't expect we'll see a new high in the market for a long time. We've had a very bad policy mix. And in addition to those economic macro factors, it's also hard to ignore that the valuation between the stock market and the bond market is the worst it has been for years. And we can see that in many charts and indicators, including this one here of the S&P 500 earnings yield less than 90-day treasury yield, showing the stock market is the most overvalued it's been since the tech bubble crash. And that's also showing up in my latest indicator for TradingView optimal stock bond allocation, which for the first time since 2007 is recommending a higher allocation to bonds than stocks at almost 57%, bonds versus stocks 43%. So this is my own custom indicator with my formula that measures the valuation of the stock market versus the bond market. And so it's been the age-old question in the investing business is what allocation should you have to stocks versus bonds, with the most popular being 60-40, stocks to bonds. However, there's many other ways you can do it out there. You can use your age to play into the formula as well. For example, one way you could do it is subtract your age from 100, and that could be your allocation to stocks rebalanced yearly. So for example, if you're investing for your kid at 10 years old, that would be a 90% allocation to stocks. And then by the time you're in your later years, at say 80 years of age, that would be a 20% allocation to stocks, with the theory being that as you get older, you want less volatility in your portfolio and more short-term certainty, as stocks are more volatile than bonds in the long run. However, with my formula, it's more based on the relative yield difference between stocks and bonds and valuation. And you can see here, back in COVID, it recommended 86% in stocks and 13% in bonds. And that was the lowest recommendation in bonds for years as well. And we can see just looking at the total bond market ETF, bonds have performed the worst over the last 3 years, as they pretty much have done in all of their history. However, that's different now because we've got higher rates, with many short-term bonds offering a higher yield than their earnings yield on stocks, and that's why we're seeing my indicator recommend a heavier weighting to bonds than stocks going forward. Another place to seek refuge in this market is none other than gold, and we've got a number of tailwinds for gold, with not only inflation, but we've also got central banks doing a lot of physical buying of gold. And earlier this year, big, large institutional investors had some of their lowest allocations to gold in years, and that's starting to reverse course as well. In addition to central banks, which added 228 tons of gold in the first quarter of this year, which was a 176% increase from a year prior. And gold has been holding up pretty well, even in the face of higher long-dated treasury yields, which is typically a headwind for gold, and the higher dollar as well. But as we can see here with gold, it has been tracking sideways for a few months. However, looking at that strong dollar index of lately, that would normally have gold sell off a bit. So I'm thinking when the dollar does have a pullback, we could see gold come up and trade above $2,000 an ounce. However, if the Fed does do another hike, then we may see a further pullback in gold below $1,900 an ounce. Also adding to the upside in gold is China, along with Russia and a few others, really wants to see the US dollar lose its global reserve status, as that is the true strength of the US economy and gives the US a lot of privileges other countries can't have, like the ability to print money, along with the most trustworthy third-party risk out there, and most foreign central banks and large investors around the world buying US treasuries, helping to keep yields low and continuing to allow US to enjoy that privilege. China slashed their treasury holdings to a 14-year low and really wants to do more of its own trade in the yuan. However, that push away from US and the West and more aligning themselves with Russia isn't coming without cost, and we can see that with the value of their currency hitting a 16-year low versus the dollar. And that's exacerbated by the fact that Chinese exports and imports are dropping by another 8.8% in August, and also their imports have fallen every month this year, as along with Russia, they have the two weakest, largest economies in the world now. And just like an angry dog pushed into a corner, it may bite back, and that's why we've already got Wall Street firms and retired military generals discussing hypothetical Chinese invasion of Taiwan. And this is a tabletop exercise that will take place in New York, and participants will explore the potential geopolitical and business implications of an invasion. And so it looks like the economic Cold War between China and the US is escalating, and that affects us all because whether we like it or not, China is the second largest economy, and a lot of US companies have a lot of production and revenue coming out of China, and that's something we've talked about on this channel before, is the risk to companies like Apple with China in the market kind of ignoring that, and that could be changing. And there's a whole lot of US companies that could be at further risk to more Chinese clampdown towards the US. A lot of the casinos like Wynn and Las Vegas Sands, and they've got others like Starbucks, Disney, Nike, not to mention hundreds of other companies still relying on China for manufacturing and production. So overall, I'd say the US still does have leverage over China. However, China does have some leverage to bite back with, and that could still hurt a lot of companies individually. And so the biggest chip maker in the world, Taiwan Semiconductor Manufacturing, under stock ticker TSM, is at great risk when China does probably invade Taiwan in the next couple of years. And the US at a government and industry levels already recognized this risk over the last year or two and started investing into more domestic production. And so while we have a lot of US companies at risk, one of them that could benefit from the Taiwan invasion will be Intel, because outside of Taiwan Semiconductor Manufacturing, Intel has the biggest and best infrastructure and capacity to produce chips outside of Taiwan, and a lot of companies may turn back to the original US leader in chips, Intel, for their production, and I'd say that's why we're getting a bit of a rally here in Intel going against the market and the semi industry in general over this last couple of weeks, even finding a fresh one-year high today on above average volume. So even though it doesn't look like right now that China will completely shut out Apple, because Apple is important for China, they do employ a lot of people there, Apple products are popular there, they don't want to do anything to upset their consumers too much. However, they are seeking to broaden the iPhone ban to all state firms. So we just got news out yesterday that they don't want government employees using iPhones anymore. However, they're looking to expand that to all departments and government-backed agencies and state companies, which is tens of millions of people. So that does have a material effect on Apple's sales there. And this could be them biting it back a little bit from Apple getting more closer with India for production and obvious moves to move away production from China, like a lot of US and other Western companies have been doing. However, that's a long-term process, and right now Apple still has a lot of exposure and risk to China, both in production and consumption. And that's why the market has wiped almost $200 billion off their valuation over the last 2 days. So what Apple's stock and the market really needs right now is a bit of excitement going into the September 12 conference, where they'll unveil their new iPhone 15, and we've still got bullish arguments from Wedbush Securities' Dan Ives saying we could still get a 20% jump from Apple, as the new iPhone 15 will drive a mini supercycle, and that a lot of customers will upgrade despite a $100 price hike. New features expected in the latest iPhone will include titanium edges, an upgraded and faster A17 chip, improved camera technology. And so if they can impress the market on their latest technology, because they did receive criticism in some of their recent releases for not making really significant jumps in the technology. And it looks like dark pool buyers may agree with Dan Ives, because we're back in the bullish zone on my dark pool percentage indicator today, with the latest reading at 57%. And they had also been buying the dip after that August sell-off as well. And we can see going back in history, the dark pool buyers have nailed the dips in Apple pretty well, and we're really pulling back their buying for most of the middle part of this year, when the stock almost reached $200 a share. And just looking at our regular chart here, it does look like today was a big dip buy, 112 million shares, double average daily volume. And just taking you down to a 15-minute chart, looks like that held right off the open and we didn't go back down to those lows. And so while we're not really technically oversold here, we're still a little bit above the buy-sell band. The DSI is only at minus 5.8. We still may come down and test this 172 tomorrow or next week, and we'll just draw a support zone in there, because if this level can hold, that may be a short-term buy the dip in Apple. The market may shrug off this China news, and by next Tuesday afternoon, after they've released their new iPhone 15, we could very well be back up towards 190. So this will be the level to watch on Apple, and this will also be key for the market overall as well. Moving on to the fear and greed index, that's back in the neutral zone at 53. Was a little busy on the options market today for a Thursday. 38.5 million contracts traded, and almost equal, just 51% calls. And interesting to see, even though the market is dipping, corporate insider sales came in at 255 yesterday, which has been the highest we've seen since March. And typically corporate insiders will increase their selling into a rip, as they're often contrarian, just like the dark pools. However, we've now got the biggest gap between selling and buying that we've seen for months. So it looks like corporate insiders don't have much confidence in this market right now. And just looking at my dark pool indicator for the SPY, that's currently at 47% in the orange, which is a moderate zone between 45 and 55%. And it doesn't look like they're getting too excited yet. And on our S&P 500 oscillator, it's currently in a bit of a neutral zone as well, around 47. So the market still has more room to dip before it gets technically oversold. However, we could find support around that 4,300 level on the SP. And just looking at the Nasdaq triple Qs, that's a bit more bearish from the dark pools as well. Still in the bearish zone at 41%. After they did do a brief dip buy in the middle of August, the theme of the last couple of months from the dark pools and the Nasdaq has been selling. And just looking at US indices, they all ended down except for the Dow, and we've got continued weakness in small caps. International stock indices are continuing to come off a little bit here as well. China falling another 2% today, and the VIX ain't all that worried, still at 14.4. Not much of a volatility risk premium in the market. We have seen a bit more hedging going on with a bit more buying of puts, and breadth is continuing to deteriorate. 38% of stocks above their 20-day average, even weaker in the medium term, 33% below the 50-day, and now we've got the majority of all stocks below their long-term 200-day average. And we're starting to see a bit of a spike up in the amount of stocks making new lows. On the NYSE 77 today, that's a new multi-month high. Same deal with Nasdaq, 118 stocks making new lows today. And that's the highest amount we've seen in a few months as well. And it looks like maybe the growth versus defensive sector spread could be putting in a double top. Like I said, all depends on Apple and NVDA. High beta stocks actually came off quite a bit today, 2.3% versus low volatility stocks. So that's that bit of a defensive rotation we saw, and growth versus value stocks as well, potentially setting up a double top formation. But still no signs of real stress in the credit markets yet. And we can see that in the spread of high yield bonds versus treasuries. Still actually in a bit of a medium-term uptrend, and still got those inflation expectations on the march higher, along with government bond yields holding up. There's a 10-year at 4.25, and TLT looking to potentially put in a bottom here. Potentially got a head and shoulders formation, along with a bit of bullish divergence in our DSI and hidden divergence indicator. And if the Fed is done, this would be a good risk reward to get into long-dated bonds at this point of time. So dollar continuing to march higher, now holding over 105. Bitcoin trying to find support at this $25,000 level. A little bit of a pullback in the commodity complex today, which is to be expected. Crude has been on a great run this last couple of weeks, so we may come back down and test this resistance zone. And for a further bull run, we want to see this resistance then turn into support. May come back down and touch its 50-day as well, and we'll see whether that can continue to find support in an uptrend. Looking across stock sectors today, mostly bearish out there. Did have the cannabis sector finish up a little bit here, but still really elevated in the short term. I would expect a bit of a pullback in this fund. And there's the worst performing sector today, semiconductors down 2.2%. And there's clean energy, which has been weak of late, down 1.8% today, but looks like it was dip bought on a hammer formation, and we do have a little bit of a bullish divergence here in our DSI and hidden divergence indicators. There's jets, which had been doing really well this year, is in a strong short-term downtrend. There's energy holding up really well, just consolidating, and there's that difference of late today with the defensive sectors actually finishing higher, healthcare, staples, and utilities. The winning sector today up 1.3% after we had got really technically oversold these last couple of days. And just looking at my custom sector trends table indicator, we can see a lot of red out there now, with most sectors underneath their 5-day moving average and their 20 and 50-day moving average, and almost half underneath their long-term 200-day average. And it's only two sectors, energy, oil, and gas, that are still green in all timeframes. So they're truly the standout sectors of this recent market pullback, and that could continue further going forward as well. Over to popular stocks, we've still got BlackRock going sideways. The banks are still a little weak, and we can see that with JP Morgan down again. Microsoft still a little soft. Google and Amazon holding up the best out of the mega cap tech. There's NVDA, actually opened today below its 50-day, but closed just above it. And this is another key one to the market. We could be setting up a big bearish divergence. And I'd say when this thing changes, it's going to change with just a big red down day, catch a lot of people by surprise, and that could really turn the sentiment in the market real quickly. However, it's still possible we break out to new all-time highs. And this and Apple are the ones I'm watching really closely for clues here, because we've got that big event coming out with Apple, which could change things. And NVIDIA is still not that far away from all-time highs. There's Tesla still consolidating into a bit of a triangle formation. And over to meme stocks, still really weak across the board. And here's the now $84 billion Vietnamese e-scooter maker, down another 26% today. I did want to short this one back here when I first mentioned it to you guys if we got a bounce. However, there were no shares available to borrow, so it looks like that one was a hard one to get a hold of anyway, but it was pretty obvious it didn't deserve the $200 billion market cap valuation it had back in late August. There's C3 AI finding new multi-month lows, and this has been one of the biggest beneficiaries of the AI hype train this year. After it started the year around $10 a share, did get up to almost $50 a share, but now we've done almost a 50% pullback, and there might have been a little bit of a dip buy here on this hammer formation, and they did come in with the earnings beat, even though they are still losing money. And just looking at the dark pool indicator, they have been showing a little bit of interest of late. Not too much, but doesn't look like they were bullish today on this dip. And across the rest of the meme space, Still some big moves we're getting down out there, and the regional banks continue to pull back a bit here, along with the big guys all in short-term downtrends. Okay, that's a wrap for today. Like I said, the market still has more room to pull back, and the chart of the S&P almost looks like Apple, and that's because Apple makes up such a large concentration in both the S&P and NASDAQ. So I'll be looking to see whether the S&P can hold this 43.50 level, and then we could go into a sideways consolidation pattern through the seasonally weak period, but I'll be looking for that to hold as support, because if that breaks through, this may be a third leg lower, and this new downtrend started from this bearish engulfing on the 27th of July. So we'll see how the market and Apple trades going into the new iPhone release on Tuesday, and whether that's enough to push the market up to new fresh yearly highs. But as they stand right now, things are still looking a little soft, and the window's still open for another Fed hike. That's it for now. Thanks very much for tuning in, and I'll see you guys again tomorrow afternoon. Cheers.